Hi, I'm Elizabeth Lumley from Finextra, and today in Conversation With, I'm speaking to Peyman Mestchian of Chartis Research, and we're going to talk about your annual RiskTech 100 list, which is read by, I know, a lot of people in the RiskTech world. So, the list that came out this year has IBM and SunGard and SAS as the top three. What criteria pushed these big names to the top of the list?
Well, SunGard and SAS have always been in the top 2 or 3, and the main reason they've always been in that area is because of the breadth of the coverage that they have in terms of enterprise risk management. So the risk technology market generally is fragmented, is made up of a lot of smaller companies with point solutions in specific areas of risk. The likes of SunGard and SAS and now IBM, they tick the box on a number of risk areas. So credit risk, market risk, operational risk, financial crime. And there really are a small number of technology companies which can act as a one-stop shop for enterprise risk management. And that's what really the top 4 or 5 players in the RiskTech 100 have. The reason IBM has gone to the first place position is primarily through acquisition. Mm-hmm. So the recent acquisition of Algorithmic, and Algorithmic was, I think, number 2 or 3 last year already. And
I remember, sort of not to interrupt you, but in the 90s there were all these rumors about SunGard eyeing up Algorithmics, and so how significant is that IBM acquisition of Algorithmic?
No, it's in the risk technology sector. It's a single most significant transaction in my market space for the last few years, and it's not significant just because of its size. It's significant because of the range of capabilities that now IBM has. I mean, IBM already had a number of assets in risk technology. They'd acquired OpenPages last year, and they already have quite a number of capabilities of their own, which they've developed through organic activities in terms of technology and analytics and data management. Now, together with the Algorithmics acquisition in terms of risk management, intellectual capital, intellectual property, functionality, Algorithmics for both the banking book and the trading book has a range of solutions. So adding that to what IBM already had in place previously has pushed them into the first place.
Mm-hmm. Do you think it's a good pairing, this, from a culture perspective?
As an industry analyst, those who sort of follow my research know that I'm generally quite skeptical about mergers and acquisitions in the risk technology space. Some of them haven't really delivered the expected returns either for the parties involved, but more importantly for the end users. With this one, I'm actually, as a firm, very positive. We think the synergies in terms of product, but also in terms of culture and the go-to-market strategy are quite strong. So we're, as a firm, we're positive about this transaction, but it's all to do with execution. I think the strategy is very sound, but we need to wait and see in terms of how well the transaction and the integration of the two firms is executed.
So something that's been written a lot about in the press since 2008, since the big financial meltdown, is this supposed renewed interest in risk and risk technology. Has that been reflected in the firm's market presence? This new, banks spending more on risk tech, more interest, has it been reflected?
No, certainly. All the research that we have done and all the secondary research that we're seeing from various consulting firms are all pointing towards it's a growing market. The expenditure on risk technology is generally growing by somewhere between 10 to 20% per annum across all the various regions across the globe. The primary driver is regulation. Mm-hmm. and it's not the actual regulations itself, it's actually more active enforcement of the regulation by the regulatory authorities, is resulting in financial institutions requiring more detailed information about the risks, the risk exposures, and the ability to drill down into the data, which requires more sophisticated technology. And some of the legacy systems that they have cannot cope with these information requirements. Hence, there's a requirement for refreshing and investment.
So you mentioned about drilling down into the data, but I mean, are banks looking for more intraday reporting? Are they looking for real-time risk reporting? And
there's definitely a requirement for more timely information. In certain areas of a financial institution where there is, particularly around the front office trading environment, it's a dynamic environment. Therefore, you need dynamic risk reporting, and that requires intraday, real time or near real time technology on certain aspects. I think some technology vendors are overplaying the real time risk intelligence piece. That they're forgetting that actually the more static batch-based risk reporting is also important, and that hasn't been done very well either. So it's important not to sort of forget that piece. The back office and the middle office still need advanced reporting. There's still issues around data quality with the batch-based business intelligence as well as the real-time business intelligence. So, but certainly real-time risk reporting. We're seeing a lot of projects. We're being called into a lot of RFPs right now around real-time risk aggregation, be it for credit risk or market risk, and then visualizing and presenting that information in the form of a real-time dashboard. So yes.
That another thing, sort of another risk topic that a few years ago seemed to be on everyone's list was liquidity monitoring and liquidity risk management. But it seems to not be the topic of conversation anymore since the bailout. I mean, have you been seeing that a lot, that there's been a lot of RFPs and requests for liquidity?
Yes, there have been. No, we are seeing there was a sort of a knee-jerk reaction in 2008, 2009. There were some specific projects that kicked off to address liquidity risk reporting. In terms of the regulation, the FSA was an early mover on liquidity risk requirements. So some of the UK banks had to move quickly on that. And we are seeing, in the whole context of enterprise risk management, Basel III, and enhanced risk governance, liquidity risk is one of those areas. But what we mustn't forget that liquidity risk is a consequential risk. So, banks run out of liquidity because something else has gone wrong on the market risk side or the credit risk side, or actually the business model is poor, so there's business risk. So, liquidity risk is on the effect side, not on the cause side. Of course, monitoring it and analyzing and reporting it is important, but there are issues earlier on in the food chain around market risk, credit risk, counterparty credit risk. And that should, if they're done right, then the liquidity issues should be mitigated.
We talked earlier on in the conversation a little bit about the IBM Algorithmic acquisition, and of course there were other acquisitions of Mises and Sophos, for example. What's next for sort of the M&A activity in this space? What more are we going to see further consolidation, or what do you predict?
I think this is more than a prediction. I know. That there are more mergers and acquisitions happening as we speak. We're advising on some of these, and there are a lot of financial technology companies who can see a growth opportunity in risk technology, but they don't quite have the right products or the solutions, so they're looking to acquire smaller sort of intellectual property-driven acquisitions around risk technology. Also, as we mentioned earlier, financial institutions, particularly Tier 2 and Tier 3 banks, are looking to have fewer vendors providing them systems. So, they're a little bit exhausted from going to one vendor for operational risk, another one for credit risk, another one for anti-money laundering, another one for market risk. If there are a few vendors who can provide more of a holistic solution, a single supplier relationship, and as a result also get cost reductions, then that's quite an attractive proposition. So some of the financial technology companies are seeing that opportunity of being a one-stop shop around risk management, which is resulting in acquisitions of the bigger firms buying smaller firms.
I mean, I want to go back a little bit, because one of the things that's fascinating to me about the risk world and also the post-financial crisis world or current financial crisis world is this idea of the difference between the reality of how banks are dealing with risk and what they say they're doing with risk. Every bank will say we have a robust risk culture, we have most sophisticated enterprise risk systems, but yet, we had a alleged rogue trader at UBS, which details are coming out that risk reports were ignored and not paid attention to. So, although there's evidence that people are spending more on RiskTech, what's your opinion? What's the reality? Do people have the systems in the building and they're not paying attention to them, or?
I think, and this is a massive generalization I'm about to come up with, but I think in general, the financial services industry is still relatively immature in terms of sophisticated risk management. For example, if you look at some of the, and actually when I say the industry, that includes the regulators as well. If you look at some of the requirements that are coming out right now around Basel III or Dodd-Frank, and the requirements that are being set upon financial institutions, and even that is getting diluted through lobbying, is basically by 2018, if all goes well, the financial services industry will be ready for the financial crisis of 2008. So it will take them 10 years to get ready for the crisis that we had in 2008. In the meantime, there are new exposures and new things are happening. So it's in a constant state of catch-up. And there's this big thing about black swans and the tail of the distribution. Well, we are in the tail of the distribution now, actually, you can argue. And therefore, most financial institutions that I speak to are firefighting. It's a disaster recovery stage, as opposed to let's sit back and think about our strategy of how we can prevent these things happening in the future. They are in the present, and the present is about tactical decisions. Let's get through the next, visit from the regulator, so that let's get through the next crisis. So, unfortunately, there's a lot of tactical decision making going on. There are some exceptions to the rule. There are some institutions that we are seeing who are looking at the long term. There are some new roles that didn't exist 2-3 years ago that have been created around new job functions such as head of risk transformation. That didn't exist 2-3 years ago. There's a number of banks in the Western economies that have that new role. So that means someone sitting back and thinking, how can we transform our risk functions so that they're more effective? The new roles such as COO of risk, as opposed to the CRO. The CRO looks at the strategy and the relationship with the outside world. The COO is in charge of executing and achieving improvements with the operations of risk management. So we're going through a transition, we're going through a transformation process, but in parallel to that, there's a lot of day-to-day firefighting and tactical activities going on.
Yeah, I've heard that before, especially, a comparison a lot of people make is, comparing the risk management to like the airline industry. You can't have a plane crash, so their risk management has to be mature, as you said. But it wasn't Lehman Brothers a massive plane crash, or RBS, or if the airline industry had as many crashes as the financial services industry had, then no one would be flying right now. So the airline industry, I've looked at the statistics on the airline industry. If the air traffic control systems, then the number is one of the safest modes of transport, and because there is no tolerance, there's no tolerance for defective systems. There is a discipline around competency of pilots and air traffic controllers. There's a culture of safety.
And of course, the airline industry, risk is a bit different to the financial services industry. In the airline industry, the risk is pure. And by pure, I mean there's only a downside. If something bad happens,
Yes.
there's a downside. In the financial services industry,
A little bit
risk
of risk
can be a
is
good
okay.
thing.
Yeah.
And you can price risk, and you can trade risk, and you can make profit from it. In the airline industry, the Wright brothers were the risk takers in the airline industry, and there were many people when they were building planes that crashed. We can argue, especially in the capital markets, we're in the Wright brothers stage of the financial services industry. We're still learning how to fly, let alone have a global system that can stop crashes.
You mentioned a little bit more, a little bit earlier about different roles for risk in banks. I mean, but has the role of the CRO, the Chief Risk Officer, changed in the past few years? Has it become more prestigious, or?
Yes, I think there are more CROs sitting on the board, and we are seeing more CROs being more or less at the same level as CFOs, and having a stronger voice in terms of the strategy of the bank. Whereas I think, again, I'm generalizing, but previously they were more of a police. They had more of a policeman type role within the bank. Now they're more of a strategy and a business-oriented role. So yes, I think the CRO's role is become much more important and prominent, and with that more prestige as well. What we're seeing, which I think is very healthy, is also a movement between risk and finance functions. We're seeing some ex-CFOs are now CROs, and vice versa. And I think that's a healthy thing, because risk as a subject is all about the future, whereas finance and accounting is about the past. And you need to actually connect those two to get a holistic view of where the business is now and where it's going. So that cross-fertilization of knowledge between risk and finance is good.
So what about, I mean, I know it's the RiskTech 100, but outside of technology, what about risk culture and the risk sort of environment? Have you seen a lot of improvements from banks on that overall risk culture and bringing risk people to the trading floor? And have you seen any improvements in that?
Generally, no. I think some institutions are working on it. It's work in progress. Ultimately, if you reverse engineer any of the major losses in the financial services industry all the way to the root cause is always a people. It's a human factor. So yes, culture and behavior are fundamental, and there is an argument that we actually spend too much time thinking about the mathematics and the technology and not enough about the people side. All these rogue trading activities, you can have the most beautiful systems and controls in place, but ultimately if you're recruiting the wrong people and giving them the wrong incentives, that will break the rules. I know there's a lot of ongoing research around the linkage of incentives and compensation systems to performance, and that's what drives behavior. But in terms of actual tangible changes, I think it's still too early. We've seen some training and development and cultural type campaigns done by banks, but it's not really systematic, and we're not seeing any movement on that from the regulators either, in terms of how do you approach the culture? If a bank inherently has got the type of leadership that drives the wrong types of behaviors in terms of risk taking, how do you regulate that? And
I think MF Global is going through that right now.
There you go.
Exactly. I mean, so another thing you mentioned about with legacy systems, any large bank is just a maze of legacy systems and siloed architecture, and data. How huge a barrier is all that data and all that legacy technology to creating a beautiful, sophisticated risk management platform?
Yeah, so we do regular surveys of the marketplace with regards to risk technology strategy, expenditure, priorities, and also obstacles and challenges to successful implementation of enterprise risk management. Consistently, the number one obstacle that comes up is data quality, by far. And that has to do with what you were saying around, the nature of risk as a subject is that you need to bring a lot of data from different sources, from financial systems, from trading systems, from front office, back office, all of it together. And now these data elements are all defined differently based on different data standards, and the systems that generate the data are not compatible. Therefore, creating a source of truth upon which then you can do risk analysis is fundamental. A risk management system is only as good as the inputs, and if it's garbage in, it's garbage out. So and we've analyzed a number of risk technology implementation projects where somewhere between 70 to 80% of the time and effort in terms of resource and cost is around just getting the data ready. Everybody is focused, on the application and the modeling and the reporting, but getting the data ready is a fundamental. So, in the RiskTech 100, we give a great amount of weighting to those risk technology vendors who give a special attention to the way that data is collected and integrated and put into the system, and with all the various reconciliation and quality checks in there, because that's a fundamental success factor.
Yep, you can talk all you want about technology. It comes down to people and data.
Yes,
exactly.
Yes, it does. It always does.
Wonderful. Thank you very much. Appreciate your time.
Thank you.